Hello and welcome to the Mutual Fund Show. My name is Niraj. In the next 25 minutes, as we spoke about, we're going to talk about how senior citizens who do not necessarily have an income, some senior citizens may have, but let's say senior citizens who've saved money with hard work all of their lives and are now looking to invest the money in order for that money to last them comfortably or over their lifetime and probably bequeath some. What is it that they can do? Are there options to traditional investments, which is like fixed deposits or bank deposits? And I know most of you will say that, yeah, we know that mutual funds are an option. The idea of today's show is to try and tell you that is there a better way of utilizing mutual funds as well in order to maximize your returns if you are indeed a senior citizen, or for that matter, if you are a retired person. Let me not preempt that everybody who's retired is a senior citizen. A lot of people my age have comfortably earned the money or comfortably chosen a lifestyle whereby they don't want to work 24 hours, 5 days a week or 6 days a week. They just want to be comfortably retired. Let's get in Sunil Jhaveri. He needs an introduction. Really joins us on the show a number of times to talk about this. Sunil, good having you. Thanks much for joining in.
Thank you.
What's your sense, Sunil, in your years of dispensing financial advice to your clients as well, and some of them might be HNIs, some of them might be middle income people, are people changing the way they save and invest now for retirement? Or rather, deploy that money during retirement?
Sure. I'll be 60 next year. So am I supposed to be in a debt instrument going forward? I don't think so. So
No, you're saying no.
no, I'm saying no, 100% no.
Okay.
The way we look at a senior citizen is that as soon as they turn senior citizen, it can be 55, 60, whenever they retire. Rather, let's call it retirement time.
Retired people, yeah.
So we tell them that you should not be in a volatile instruments like equity, and you need to be in a more stable products like debt instruments. It can be NCDs, it can be fixed deposits, it can be mutual funds, etc. But that's where the entire disconnect starts. Please understand the concept, and then we will take this chat forward. Concept of rule of 30-30, which we have discussed on your show in the past also, which says 30 years of your professional life and 30 years of your retirement life. And sometimes, as you rightly said, the retirement life is longer than the professional life also. In such a scenario, if in during 30 years of your professional life, if equity has generated returns for you and created wealth for you, what stops you from investing in equity as an asset class? I'm not saying 100% equity because you don't want that volatility attached to that, but I'm saying that you should have infusion of flavors of equity so that it lasts you. Because if you want to beat inflation on an ongoing basis and still generate regular cash flow and maybe wealth for yourself as well as your beneficiaries, then the best way to do it is infuse some flavors of equity. So that's the starting point. The disconnect and the myth of not investing in equity as an asset class for senior citizen is what should be broken, and that's the message which I would like to convey through your show to all the senior citizens or all the retired people. Let's put it that way.
Right. So just a quick throwback though. Uh, there are a bunch of people who are retiring who have not created wealth through equity. A lot of people that I know and a lot of people across are probably people who have maybe started using mutual funds only in the last 2 years. Some of them are still not using mutual funds. They may have worked for 25, 30, 35, 40 years in a hard earned job, but have not used equity as a savings instrument. So their returns may not be as good, but they have a sizable portfolio. Now, that's the question, really, right? There's a set of people who are not tuned to investing into mutual funds at all. Forget equity versus debt funds. And that's what my message is. So first, one quick, just spend a minute on the behavioral aspect, because there are a lot of people who are not comfortable with equity at all. I mean, mutual funds also. Forget equity mutual funds. They are probably not even comfortable with debt mutual funds. So what do people do? You are saying that people, even if they have not invested in equity at all in their entire life or mutual funds in their entire life, this is the right time to start doing it for the retired life.
Absolutely. The disconnect is because they treat financial assets as their own generation assets. Unlike property and the jewelry which they own, they treat it as a multi-generation asset. and they don't mind. They've never looked at the price of a property or price of jewelry once they've bought it. And then they know that this particular asset class will be transferred from one generation to the next generation to the third generation, and that's the reason why they don't bother looking at it on a day-to-day basis. Now, once you start looking at your financial assets as the multi-generation asset, which it should be treated in the same light as your property and your jewelry, then they will have a different take and a different way of looking at these investments. Unless and until you have, as I said, infusion of flavors of equity. Let me give you one example. At the age of 60, we are asking a person to invest in debt as an instrument, or maybe he's used to investing in debt as an instrument. But that 1 crore adjusted for inflation, let's assume 6% inflation, after 25 years, the value of that 1 crore in terms of its purchasing power is only going to be 23 lakh rupees. So what risk have they not taken? The biggest risk, as I've been saying, is not taking any risks, what Mark Zuckerberg has said. But I'm saying this is classically true for senior citizens who are taking no risk by not investing in equity as an asset class, thinking that they want to avoid volatility. They don't want to be in a riskier asset class because they have always treated that financial assets as my generation asset and never as a multi-generation asset.
No, sorry, I just have a bit of a counter there, and I can understand where some of your numbers might be coming in, but this whole idea of or notion of 1 crore at 6% inflation after 23 years is 23 lakhs. Does it assume no returns from the debt investment, or does it
No,
assume
not at
a
all. Of
minimal
course,
return? Huh.
no. It assumes some returns, but that return is going to be eaten because that's a regular cash flow which you are going to eat, right? You're going to be depending on that cash flow for your day-to-day
Sure.
requirements. So once if you are not able to, when you are in a professional life, you will have incremental cash flow beyond what you are spending, and that's the reason why you're able to save, and then that's the reason why you're able to invest. But in a no generation of income kind of a story, which happens post the retirement period, uh, there will be some income generation on the debt instruments, but that is what you're going to be consuming yourself. But at the same time, the purchasing power of that 1 crore, that 1 crore has to grow over a period of time. It's like saying that 25 years back, if I had taken an insurance of 25 lakh rupees, which was a big insurance in those days, because people used to take 1 lakh and 2 lakh term insurance at that point in time. What is that 25 lakh rupees worth currently if I'm no longer there for my beneficiaries? So put it in that perspective, you will realize what I'm trying to say.
I get your point. Okay, so viewers, I hope these numbers are hitting home. If you are indeed a senior citizen, or if you're indeed somebody who's looking to retire, then even if you invest in a debt instrument which is giving you an X percentage of return and trying to use some of that money, presuming that you will use some of that money as it comes into you for your day-to-day expenses, 1 crore after 25 years will only be 23 lakh rupees based on some calculations. Now, you got to believe that some of these calculations are correct as well, because they would largely be. Now, Sunil, therefore, my question to you then is that what should a person who is retiring, let's say 2 years from now, 1 year from now, or has just retired and has parked his money or her money in banks, in fixed deposits, in debt instruments do? You are saying introduce a flavor of equity. What about safety?
As I said, safety is really not their concern as long as they get regular cash flow and emergency cash. These are the two main aspects. What do senior citizens want? They want regular cash flow, they want emergency cash, they want safety of principal, and they want to leave something behind for their kids. So these are the four requirements of any senior citizen. As long as your first two requirements are taken care of, which is your regular cash flow and your emergency cash, they should not really bother about safety of principal. If the senior citizen is leaving behind 1 crore or 95 lakhs, that they have a beneficiary who can take that journey forward for the next 30 years thereafter. So why have they
Sure.
bought that? So as long as they need their cash flow, so they have to differentiate between a cash flow requirement versus returns. For a senior citizen or for a retiree, the most important aspect is the regular cash flow rather than the returns part of it. The returns will definitely follow. Returns will be there on debt instruments also, and returns will be there in schemes like dynamic asset allocation fund. And that's what I'm taking this whole journey towards dynamic asset allocation funds by saying that slowly and steadily you must infuse flavors of equity. So that
Okay.
corpus Copper should be invested in your dynamic asset allocation fund. Keep aside some liquid fund for your emergencies, etc. And that's the way your journey should carry forward. And you do a SWP from there for your regular cash flow requirement.
No, no, sorry. So let's try and simplify this, Sunil. What is the ideal strategy according to you? And can we talk some numbers here?
Sure. So let's assume that I'm giving you a specific example of if you had invested in one of the schemes in 2010, which was a dynamic asset allocation fund, and we have covered dynamic asset allocation fund on your show in the past also, which rebalances between debt and equity based on the market valuation. So when the markets go expensive, they will reduce the exposure to equity and vice versa. So in this example, which you are seeing on the chart, if you had invested 1 crore in 2010 April and you had done a SWP, systematic withdrawal of 8 lakh rupees per annum, which is 67,000 rupees per month, after withdrawing 83 lakhs from 2010 to 2020, the current value of that scheme is still 1.48 crores, on which you have only, on that 83 lakh rupees SWP, you only ended up paying 3 lakh 40,000 as tax. As against that, if the same 83 lakhs has come to you as interest from fixed deposits, assuming 30% tax rate, you would have ended up paying 24 lakh 90,000 as tax on that FD. So first of all, you're making your investments also attractive by getting into infusion of flavors of equity and making it even tax efficient at the same time. So both the aspects you take care of, your regular cash flow and your tax efficiency. And, and by the way, a lot of investors depend on dividend for their cash flow requirement, which is also a wrong way of looking at it,
Yeah.
because can be only declared out of realized profits. So that's not the right way of going about it. The best way to go about it is invest in a growth option in a DAF kind of a scheme, and then do a SWPs. You start with a less percentage, 6%, 7%. Let the cushion build up in your portfolio, and then if you want to increase your SWP from 6% to 7% to 8%, if your value of 1 crore has grown to 1 crore 48 lakhs in spite of 83 lakhs withdrawal over this period, you can very easily start withdrawing 10% per annum instead of 8%.
Okay, now Sunil, can I have that played back, and can I get Sunil to enumerate that example again? So let's get that played back on your screen, which is talking about the withdrawals. Now, Sunil, can you simplify this for us? If the investment amount was 1 crore, let's say we are right now on April 1st, 2010, and if a senior citizen is investing 1 crore in a dynamic asset allocation fund, right? This is a live example that you've given us,
Correct.
right? So
Yes.
what is this? How does this number 67,000 come about? Is it an ad hoc assumption of a particular sum that the person will remove every month? How does that come about? And then tell
Yes.
us, how does the current value go up to 1.48 crores?
Sure. So this is assuming investment of 1 crore initially, on which you are withdrawing 8% per annum, which is 8 lakh rupees per annum, divided by 12 is 67,000 rupees per month. The underlying scheme has grown at higher return than higher than 8% per annum. That means it would have grown at 10% or 12% over the past 10 years or so. And that's the reason, in spite of that withdrawal of 83 lakhs or 8 lakhs per annum, the current value of that scheme after that withdrawal also is 1.48 crores.
Okay, so you've chosen a conservative withdrawal assumption of 8% because the scheme has actually grown higher than 8%. So 8% is a safe assumption to me.
Absolutely. If I would have started with 6% to start with or 7% to start with, the 1.48 crores would have been looking at maybe 1.6 or 1.7 crores currently.
Wow. Okay. And so Sunil, the other question that somebody who's watching the show right now would have is there a way to assume again, it's an assumption, viewers, keep in mind, because it's a hypothesis that you build that this is what the fund could possibly return. But is there a way to assume, Sunil, what's the kind of average return that a dynamic asset allocation fund from 26th August 2020 or 27th August 2020 could deliver over the next 10 years?
It's very difficult to judge what it will deliver over the next 10 years or so. But what we can do is, based on the past performance, based on the past averages, let's assume the past average of 5-year daily rolling returns is say 10% in that product. If that be the case, then you start with a 6% or a 7%, and then you build on that. And see, mind you, that at some point in time you will dip into your principal. Let's assume you
Hmm.
started in 2019, 1 crore investment, and you started doing straight away 8% withdrawal, and on top of that, the markets have also corrected. Maybe you are at 93 lakhs or 95 lakhs currently in its value, but over a longer period of time, because of the underlying growing at higher returns than what you are withdrawing, will take over on the average side, and then finally you will have this kind of figures which you just saw. Worst comes to worst, Niraj, let's assume that I leave behind 95 lakhs, but I'm still getting my regular cash flow which I wanted. Now, what is the dilemma of a senior citizen? First of all, interest rates are at decadal lows. At 5%, 6% kind of a fixed deposit rate, on which you will end up paying 20%, 30%, or 10% tax, whichever tax bracket you are in. You have rising medical bills, you have wealth erosion because of the inflation eating into your purchasing power. Your life longevity is increasing, because nowadays you see that people live till 85 or 90 also, so your longevity is also there. How do you survive during this long period of time when there is no income generation possibility for a retired person? They
Got
need
it.
a regular cash flow. They have earned this money. It is their hard-earned money. They will, parents being parents will always think, I want to leave something behind for the kids. Now that's an emotional side of the story. But will
But we
I?
can't get into that. Yeah, sure,
Yeah, but
fine.
I'm saying, will I sacrifice my living peacefully and comfortably just so that I leave something behind for the kids? If I
Got
leave
it.
behind
Okay.
something behind for the kids like 90 lakhs instead of 1 crore, how will that impact the beneficiaries? They have 30 years more to go.
Okay, sure. Now, viewers, I want to make a couple of points clear out here. One, that this is one measure which Sunil Jhaveri is suggesting is a good measure. Maybe you already have a financial advisor, and that financial advisor could be suggesting something else as well. It might be worthwhile to check the efficacy of this with your financial advisor if you find some merit in the argument being made on the show today. Now, for a lot of you who are completely aware of what a dynamic asset allocation fund is, great, you know it. But Sunil, just spend 60 seconds trying to tell our viewers what would this dynamic asset allocation fund do, because a lot of people would believe or get confused between investing in debt funds versus investing in mutual funds, because Sunil Jhaveri or BloombergQuint in the show did mention that you should take exposure to equity. So maybe they might go up ending investing in an equity fund. So what would a dynamic asset allocation fund do, and are there good dynamic asset allocation funds currently available in the market?
Sure. Let me first of all tell you that there is one category called balance fund now, which is called hybrid fund, which is totally different from these dynamic asset allocation funds, which I call rebalancing funds. Please differentiate between the two, and we are not recommending hybrid funds or the balance funds, because they are 65 to 70% always in equity as an asset class. So I'm not talking of that segment at all. Dynamic asset allocation funds in the segment, the way it is right now designed, is there will be minimum 30% in equity if the markets are extremely expensive, and maximum of 100% in equity if the markets are extremely cheap. And they will move between this on a either daily basis, they will do rebalancing, or a fortnightly basis, or a monthly basis, or whichever ways, but they will do rebalancing based on the market dynamics in terms of expensive or cheap, and that can be based on price to earning, price to book, dividend yield, or a combination of all these three factors. Practically every AMC or a mutual fund house has a dynamic asset allocation fund, from ICICI Prudential to Motilal Oswal to SBI to DSP to Nippon. Every single fund house will have a dynamic asset allocation fund.
Okay. You okay. And just one follow-up question to that. There is no, I mean, usually if funds invest less than 65% in equity, then the taxation is not like an equity fund. That is not a hindrance when it comes to this.
Not at all, because if you are 30% in equity, the 35% will be in arbitrage. So that makes it 65% minimum in equity. And arbitrage is a buy, it's 100% hedged equity position. So it is absolutely safe as far as the investment side is concerned. But you treat arbitrage portion as a debt portion only. So just to make it equity taxation, they resort to arbitrage, or they can go short on Nifty.
Okay. And for my last question, Sunil, on the show, for a retired person, uh, and again, I'll tell you what I'm asking this, because there are a lot of people who come in and say that if indeed the retired person has some corpus which the person can use in the current scheme of things, then it might be advisable to invest in pure equity funds, because over the long term, nothing beats the returns in equity funds. That's something that a lot of people have come and said. Do you agree with that, or do you reckon that it's better to have all the corpus brought in into a dynamic asset allocation fund strategy right from the word go?
I totally don't believe that a senior citizen should be in 100% equity products. Uh, if at all you want to create your own dynamic asset allocation fund through asset allocation strategy, that is entirely your call, but it's a very difficult proposition for individual investors to do that. And that's the reason why this DAF category is very popular. I like that as a category. Whenever we want to go to a conservative asset class, we go to a DAF kind of a category. Having said that, let me explain to you what a person who's likely to be retiring in the next 5 years. If I were to do a SIP, say in an equity fund, SIPs have delivered negative returns over 5 years also, from 2004 to 2009, or from 2015 to 2020, as we have seen till March. And if I wanted to retire after 5 years, if I'm starting with a negative corpus, naturally, where will I go? So ideally, SIP also for somebody who's about to be senior citizen or he's already a senior citizen should happen in a DAF kind of a product, because generally DAF over a 3 year period does not deliver negative returns. I'm just making a general statement. Individual DAFs may have different, performance analysis, but 99% DAFs, they do not generate negative returns over 3 year period. If that be the case, then even SIPs over 3 year or 5 year should not deliver negative returns.
Yeah, but they have done, and as I think one of the examples that we have, that I think from about March of 2004 to March of 2009, um, the an
It
SIP
may be negative, but the DAF would have delivered positive. But unfortunately, those days DAF was not there in
not there.
existence.
Hmm.
Yeah, but the back tested models which we have seen, that DAF would not have delivered negative return.
Got it. So viewers, keep that in mind. That if you are indeed a conservative person who doesn't want any kind of risk, and who, let's say, you're retiring 5 years from now and doesn't want a negative corpus, maybe uh, an equity SIP might also not be a good idea, because 5 years is a long time. But if it's still delivering negative returns, maybe not. So if you are young, if you have time on your hand, if it doesn't matter if there is some amount lost here and there, then maybe equity SIPs would anyway score, or probably always score. Keep in mind, this is very specific for kind of people who are either retiring or about to retire or have already retired. Okay, Sunil, very quickly, last comment. Anything else that we missed out in terms of advice via use of mutual funds or DAF products for senior citizens?
See, it has all the possible trappings, or the what is required for a senior citizen. The other advantage of getting into a mutual fund is that you can do reallocation between the beneficiaries right from day one. So let me give you an example. Let's assume that I have a sibling, and my parents wanted to invest, say, 1 crore rupee. 50 lakhs could be in my mother's name, and my name is a second name. Another 50 lakhs, another folio could have been in my mother's name again, and the second name should have been my sibling's name, my sister's name. Whenever this person is no longer there, the transmission of units happens, and that's the reason why allocation, or allocation of the wealth of that senior citizen happens automatically, and there is no requirement of will, etc. Of course, when I will should be part and parcel. I'm not saying that you should not have a will for a senior citizen, but even if there is it is not there, you have done your allocation, you've done your distribution of your wealth based on what you wanted to do post you not being around, automatically on day one of your investment also. So that is one positive side of the story as far as the mutual funds are concerned. Regular cash flow and tax efficiency is the second side of the story, and infusion of flavors of equity and creating wealth beyond your cash flows also. So all this put together is not really available in many traditional products, so to say.
Okay. Well, Sunil, thank you so much for joining us today and giving us your thoughts. Really appreciate your time, and stay safe.
Thank you. Same to you.
Thank you. Thank you,
Yeah.
Sunil. And viewers, I hope you benefited either for yourself or the sake of your parents. If indeed you're watching this, and if your parents are either retirement age or around that, maybe make them watch this as well. It could give them a hint or two about how to reallocate their investing strategy when it comes to retirement planning. Thanks so much for tuning in to the mutual fund.